Greetings and welcome to the Cummins Q4 2020 earnings conference. At this time, all participants are on a listen-only mode. A question-and-answer session will follow the formal presentation. If you would like to ask a question during today's conference, please press star 1 on your telephone keypad. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Mr. Jack Kinsler, Executive Director of Investor Relations. Thank you, sir. Please go ahead.
Thank you, and good morning, everyone, and welcome to our teleconference today to discuss Cummins results for the Q4 and full year of 2020. Participating with me today are our Chairman and Chief Executive Officer, Tom Linebarger, our President and Chief Operating Officer, Tony Satterthwaite, our Chief Financial Officer, Mark Smith, and the President of our Components business, Jennifer Rumsey. We will all be available for your questions at the end of the teleconference. Before we start, please note that some of the information that you will hear or be given today will consist of forward-looking statements within the meaning of the Securities Exchange Act of 1934. Such statements express our forecasts, expectations, hopes, beliefs, and intentions on strategies regarding the future. Our actual future results could differ materially from those projected in such forward-looking statements because of a number of risks and uncertainties. More information regarding such risks and uncertainties is available in the forward-looking disclosure statement in the slide deck in our filings with the Securities and Exchange Commission, particularly the Risk Factors section of our most recently filed annual report on Form 10-K and any subsequently filed quarterly reports on Form 10-Q. During the course of this call, we will be discussing certain non-GAAP financial measures, and we refer you to our website for the reconciliation of those measures to GAAP financial measures. Our press release with a copy of the financial statements and a copy of today's webcast presentation are available on our website at www.cummins.com under the heading of Investors and Media. With that out of the way, we will begin with our Chairman and CEO, Tom Linebarger.
Thank you, Jack, and good morning, everybody. If that voice sounded different to you, it's because it was. That was Jack Kinsler, not James Hopkins. And I want to welcome Jack to the Investor Relations function and to this quarterly earnings call. Jack's not new to Cummins. He's been with the company since 2014. He's worked in finance. He's worked in strategy. He has a great understanding of our business and our financial performance. He'll be a terrific addition to the Investor Relations team. And he will, I think, continue James's efforts to not only improve communication with investors, but make sure that you have the insights and understanding you need of our business and financial performance. James also worked with managers across the company to make sure that we understood what you as investors need from us. And for that, I'm very grateful. James is now working in the engine business and strategy, and I know he'll do a terrific job, so thanks to James. Before I go through the summary of our Q4 and full year results, I want to take a moment to acknowledge and thank our employees for the sacrifices they've made over the course of 2020. In the Q2, we faced the most severe decline in quarterly sales in our history, followed by a rapid recovery in demand and supported by a supply chain that was severely impacted by the pandemic. Our employees have worked tirelessly to navigate the many challenges caused by COVID-19 across the globe in order to support our customers and operate with financial discipline. I can't thank them enough for their commitment, their agility, and their resilience. Now I'll summarize our Q4 and full year results and finish with a discussion of our outlook for 2021. Mark will then take you through more details of both our Q4 financial performance and our forecast for this year. As a reminder, in the Q4 of 2019, we recorded restructuring charges totaling $119 million pre-tax or $90 million after tax. In order to provide clarity on operational performance, I'm excluding any references to those charges from my comments. Revenues for the Q4 of 2020 were $5.8 billion, an increase of 5% compared to the Q4 of 2019, driven primarily by increased demand in Chinese truck and construction markets. EBITDA was $837 million, or 14.4%, compared to $682 million, or 12.2% a year ago. EBITDA percent increased due to higher revenue, stronger joint venture income, and benefits from restructuring actions taken in the Q4 of 2019, partially offset by higher product coverage costs. Q4 EBITDA included $36 million of reorganization and facility closure costs associated with actions taken to improve future performance, primarily in our distribution business. For the full year, Cummins sales were $19.8 billion, down 16% year over year. Our EBITDA margins were $3.1 billion, or 15.7% of sales, compared to $3.7 billion, or 15.8% of sales in 2019. In our engine business, sales decreased by 20% in 2020. Lower demand in most of our major regions and markets was partially offset by record levels of demand in the on-highway and construction segments in China. EBITDA was 15.4%, compared to 14.6% in 2019, as the benefits of higher joint venture income, restructuring, and temporary salary reductions more than offset the impact of lower volumes. Sales for our distribution business decreased by 12% in 2020, driven by lower demand for engines and power generation equipment, in addition to lower utilization of our products across many of our regions, driving lower aftermarket demand. Full-year EBITDA increased to 9.3%, compared to 8.6% in 2019, driven by the realization of benefits of our transformation activities, especially in North America, and other cost reduction actions. Full-year revenues for the component segments declined by 13% due to lower truck production in North America and Europe. This more than offset increases in revenue associated with new products designed to meet Bharat Stage 6 emissions regulations in India and record levels of truck demand in China. EBITDA was 16.0%, compared to 16.2% in 2019. The decrease in EBITDA percent was primarily due to lower volumes, which more than offset the benefits of restructuring actions, temporary salary reductions, and lower warranty expense. Power Systems sales decreased by 19% in 2020. Sales of our power generation equipment declined by 14% as lower demand for standby power generation equipment in North America, India, and Asia more than offset continued strong demand in data center markets, especially in China. Demand for engines and industrial applications declined by 26% due to lower demand in oil and gas and mining markets. EBITDA was 9.4%, compared to 11.7% in 2019. The decrease in EBITDA was primarily driven by lower volumes, which more than offset the benefits of prior restructuring actions and temporary salary reductions. In our new power business, revenues increased by 89% to $72 million, primarily driven by electrolyzer demand. Full-year new power EBITDA was a loss of $172 million, in line with our forecast, as we continue to invest in new products and technologies ahead of widespread market adoption. And before I move on to some of our key markets, I'd like to take a moment to provide an update on the progress we made in new power in 2020. First, we delivered a 20-megawatt PEM electrolyzer system to generate green hydrogen in Bécancour, Quebec, making it the largest operation of its kind in the world. The Cummins electrolyzer system is installed on an Air Liquide hydrogen production facility and began commercial operation late last year. The Cummins PEM electrolyzer can produce over 3,000 tons of hydrogen annually using hydropower. In addition to the Bécancour installation, we delivered 4 megawatts of electrolyzers to 9 additional customers in 2020. We provided fuel cell modules to ASKO, Norway's largest grocery wholesaler, that were integrated into 4 Scania trucks. The fuel cell electric truck pilot is the first of its kind, as ASKO aims to reduce its energy use by 20% and ultimately become a self-sufficient provider of clean energy using 100% renewable fuel. Cummins also supplied fuel cells for Fawn, a leader in waste collection vehicles and sweepers in Europe, for their electric refuse truck program. Cummins is also the largest supplier of fuel cells for the rail industry, and we are using experience from rail applications in our design for other heavy-duty transportation applications to provide best-in-class solutions. In the battery electric market, we delivered 147 fully electric powertrains to Blue Bird in 2020 for use in the school bus market, and 19 powertrains to Gillig for use in the transit bus market. Our products are now powering over 250 school buses, which are actively in service today, in addition to transit buses operating in municipalities around North America. Finally, we formed the NPROXX joint venture in 2020 to provide customers with high-pressure tank and storage solutions in hydrogen and natural gas markets. We have a strong portfolio of distinctive platforms and are continuing to invest in key technology areas for the future. We are targeting our focus and investment at the markets where commercial opportunities exist today or will emerge in the near or medium term. The experience we are gaining in the field is providing us opportunities to continuously improve our products and leverage prior investments into new applications. In addition to the technical experience we are accumulating, our sales and service channel, customer relationships, and global footprint will position us well when broader commercialization of fuel cell electric powertrains and battery electric powertrains take place. Now I will comment on some of our key markets in 2020, starting with North America, and then I'll comment on some of our largest international markets. Our revenues in North America decreased 21% in 2020, primarily due to lower demand across our segments in response to the COVID-19 pandemic. Industrial production of heavy-duty trucks declined to 187,000 units, a decrease of 39% from 2019 levels, while our heavy-duty unit sales declined to 63,000, a decrease of 36% from 2019. We began shipments of our X12 engine to Freightliner for use in their Cascadia day and sleeper cab models in 2020, in addition to sales in various vocational applications. Our entry into the regional haul market with the low-weight X12 engine will further support our leading market share in this segment. The market size for medium-duty trucks was 101,000 units in 2020, a decline of 28% from 2019 levels, while our unit sales were 78,000, a decline of 32% from 2019. We shipped 125,000 engines to Chrysler for use in their Ram pickups in 2020, a decline of 14% from 2019 levels. Engine sales to construction customers in North America decreased by 42% as non-residential construction spending declined and rental companies cut capital spending. Engine shipments to high horsepower markets in North America decreased by 11% from last year, with lower demand from oil and gas and mining segments, partially offset by increased shipments to marine and defense customers. Power generation revenues decreased by 13% year over year, driven by lower demand for standby applications resulting from lower non-residential construction spending. Our international revenues declined 7% in 2020, with weaker demand in most markets more than offsetting a record year in China. Full-year revenues in China, including joint ventures, were $6.9 billion, up 25%. The increased revenue was driven by record demand in the truck, construction, and data center markets. Industry demand for medium and heavy-duty trucks in China was 1.8 million units, an increase of 35% driven by increased incentives to scrap older trucks and an increase in government stimulus following the easing of COVID-19 restrictions. Our units sold, including joint ventures, were 286,000, an increase of 47%. The light-duty truck market in China increased 17% from 2019 levels to 2.2 million units, while our units sold, including joint ventures, were 189,000 units, an increase of 24%. Industry demand for excavators set another record of 328,000 units in 2020, an increase of 39% from 2019 levels. Our units sold were 53,000 units, an increase of 58% as our domestic partners gained market share. In our power systems markets, demand for power generation equipment in China increased 8% compared to 2019, driven by growth in key markets such as data center, infrastructure, and healthcare. Industrial engine sales declined 34% from 2019 levels, primarily driven by weakness in oil and gas and mining markets. Full-year revenues in India, including joint ventures, were $1.2 billion, down 26%. Industry truck production declined by 54% in 2020. Demand for construction equipment dropped 28%, and power generation revenue declined 40% in 2020. Our components business was the one major bright spot, with revenue up 17% as a result of new products designed to meet the Bharat Stage 6 emissions regulations introduced in April, in addition to new customer wins. In Brazil, our revenues declined 11%, driven by weaker demand in most end markets. Now, let me provide our overall outlook for 2021 and then comment on individual regions and end markets. We are forecasting total company revenues for 2021 to increase 8 to 12% compared to 2020, driven by an increase in heavy-duty and medium-duty truck production in North America, Europe, and India, offset by China, where we expect demand to moderate after a record year in 2020, particularly in the second half of the year. We expect demand for construction equipment to increase in North America and Europe and decline in China from record levels experienced last year. We are forecasting higher demand in global mining, oil and gas, and power generation markets and expect aftermarket revenues to increase by 10% compared with 2020. Industry production for heavy-duty trucks in North America is projected to be 245,000 to 265,000 units in 2021, a 30 to 40% increase year over year. In the medium-duty truck market, we expect the market size to be 120,000 to 130,000 units, a 20 to 30% increase from last year. This year, we will begin selling engines to Isuzu for use in the medium-duty truck markets. We have been working with Isuzu on multiple collaboration initiatives since 2019, including the delivery of next-generation low-emission products, and are excited to take our partnership to the next level. We have delivered some initial units which are being incorporated into vehicles in North America now and plan to begin serial production in the second quarter of 2021. In 2023, we expect to supply engines to Isuzu for truck applications in Japan and Southeast Asia. Our engine shipments for pickup trucks in North America are expected to be up 5% compared to 2020. In China, we are projecting domestic revenues, including joint ventures, to be down 20% in 2021. We currently project a 30% reduction in heavy and medium-duty truck demand and a 5 to 10% reduction in demand for the light-duty truck market. We expect demand to be heavily weighted towards the first half of the year, particularly in the first quarter, and primarily driven by pre-buy ahead of the broad NS6 implementation in July, and OEM efforts to increase inventory levels to mitigate supply chain constraints. Industry volumes of NS6 product will increase in 2021 as the new regulations are implemented more broadly across China from July onwards. We first launched engines to meet standards similar to NS6 in the United States 10 years ago and have leveraged our knowledge in powertrain technologies to develop a range of products for Chinese markets that we expect to be well received by end users. Industry sales of excavators in China are expected to decline 20% from last year's record levels. We also expect demand in the first half of the year for excavators to be stronger than the second half, driven by infrastructure projects and a strong housing market, which is expected to decline in the second half of the year as the government stimulus tightens. In India, we project total revenue, including joint ventures, to increase 25% in 2020. We expect industry demand for trucks to increase 20% in 2021. The new emission standards in China and India will result in significantly more content for each Cummins engine we sell. For example, we expect to increase sales of after-treatment systems by over $250 million in 2021. We project our major global high horsepower markets will improve in 2021. Sales of mining engines are expected to increase by 10 to 15% in 2021, with greater demand following a recovery in commodity prices. Demand for new oil and gas engines is expected to increase by 55% in 2021, albeit off a very low base, primarily driven by increased fracking activity in North America. Demand in global power generation markets is expected to increase 5%, driven by continued growth in data center markets and strong RV market in North America. In new power, we expect full-year sales to be between $110 million and $130 million. We have a backlog of approximately 65 megawatts in electrolyzers, which we expect to be delivered over the course of the next 12 to 18 months. We will continue to deliver fuel cell systems for use in the European rail market. We also expect to provide modest volumes of fuel cells for truck applications in 2021 as some fleets try out the new technology. We are continually innovating across our broad portfolio of power solutions, from diesel and natural gas to fuel cells, hybrid, and fully electric options. We plan to provide our customers with the right technical solution for their application at the right time and to continue to be a leader in power for commercial and industrial equipment. While current indicators point to improving demand in a number of key regions and markets in 2021, significant uncertainty remains, requiring continued strong focus on managing costs and cash flow as our markets continue to recover around the world. We are still operating under a pandemic, with extreme safety measures in place, and our suppliers and customers are doing the same. This is presenting challenges to global supply chains as our industry responds to rising demand across multiple end markets. Having effectively managed through an extremely challenging 2020, Cummins is in a strong position to keep investing in future growth and continuing to return cash to shareholders. In summary, we expect full-year sales growth of 8 to 12% and EBITDA to be in the range of 15 to 15.5% of sales. The benefits of higher volumes and ongoing cost reduction activities will be partially offset by lower joint venture earnings, investment in new products, and some additional costs with supply chain inefficiencies and the year-over-year impact of restoring full salaries following temporary salary reductions between April and September last year. Now, let me turn it over to Mark, who will focus on our financial results and discuss them in more detail. Mark?
Thanks, Tom, and good morning, everyone. I'll start with a quick summary of our financial performance in the fourth quarter and full year 2020 before moving to our outlook for 2021. As a reminder, in the fourth quarter last year, 2019, we recorded restructuring charges of $119 million pre-tax or $90 million after tax. I'm going to exclude any references to those charges in my subsequent comments to provide clarity and consistency on the underlying operating performance. There were four key highlights this quarter. First, the pace at which customer demand for Cummins products rebounded, and our employees' agility in responding to the higher customer orders. Second, we delivered solid profitability, especially when we peel back the expenses associated with cost reduction activities and some elevated costs tied to a tightness in global supply chain. Third, we converted the sales into cash, delivering $1.1 billion of operating cash flow, our second consecutive quarter of delivering more than $1 billion in cash. And fourth, we increased cash returns to shareholders in the fourth quarter as visibility to improving demand increased. Now let me go into more details on the fourth quarter and full year performance. Fourth quarter revenues were $5.8 billion, an increase of 5% from a year ago, and snapping a 5-quarter run of declining sales. While the origins and depths of each of the downturns in the past 20 years have varied, each one has yielded negative sales growth for Cummins of between 4 and 6 quarters. Sales in North America were flat, and international revenues increased 12%. Currency movements in aggregate had a minimal impact on revenues in the fourth quarter. EBITDA was $837 million, or 14.4% of sales, compared to $682 million, or 12.2% of sales a year ago. EBITDA dollars increased by $155 million as the positive impact of higher sales, the benefits of restructuring, and lower variable compensation expense more than offset higher product coverage costs and additional supply chain costs. Fourth quarter EBITDA included $36 million of expenses associated with the reorganization activities and facility closures, primarily driven by transformation initiatives in our distribution business. That $36 million was equally split between gross margin and our operating expenses. Gross margin of $1.4 billion, or 23.3% of sales, increased by $48 million, but decreased as a percent of sales by 20 basis points year over year. Higher product coverage expense and additional costs associated in meeting rising demand more than offset the positive impact of higher volumes and the benefits of restructuring, leading to a slight reduction in gross margin as a percent of sales. Combination of a sharp recovery in demand in nearly all of our end markets and the ongoing COVID-19 pandemic have led to tightness in global supply chains. We leveraged our global footprint to respond to the rapid increase in demand, but did incur additional freight and labor costs in doing so, which reduced fourth quarter margins by approximately 60 basis points. We anticipate that these elevated costs will continue through the first half of 2021 and have incorporated them into the midpoint of our guidance for this year. Selling, general, and administrative expenses decreased by $56 million or 9% due to the benefits of restructuring, reduced discretionary expenses, and lower variable compensation. Research expenses decreased by $16 million or 6% from a year ago. Joint venture income increased by $36 million, primarily due to continued strong demand for trucks in China, which we converted into earnings growth, and higher profits in our India operations. Other income of $24 million increased by $4 million from a year ago. Net earnings for the quarter were $501 million, or $3.36 per diluted share, compared to $390 million, or $2.56 from a year ago. The effective tax rate in the quarter was 19.7%. Operating cash flow in the quarter was an inflow of $1.1 billion, $304 million higher than the fourth quarter last year. Higher earnings and lower working capital contributed to the strong cash generation. Now I'll move to the full year 2020 commentary. Revenues were $19.8 billion, a decrease of 16% or $3.8 billion from a year ago, the largest dollar decline in sales in company history. Sales in North America decreased 21% and international revenues decreased 7%. Currency movements negatively impacted revenues by 1%. EBITDA was $3.1 billion, or 15.7% of sales for 2020, compared to $3.7 billion, or 15.8% of sales a year ago. The benefits of restructuring, lower compensation expenses due to temporary salary reductions, lower variable pay, and record joint venture performance in China were more than offset by the impact of lower volumes. The record performance in China is remarkable when considering the COVID-related restrictions faced by our people and operations in the first quarter last year and throughout much of the remainder of last year. Net earnings were $1.8 billion, or $12.01 per diluted share. This compares to $2.4 billion, or $15.05 per diluted share a year ago. Importantly, our results in 2020 extended our track record of raising performance over successive cycles, with earnings per share 46% higher than we delivered in the prior downturn of 2016. Full-year cash from operations was an inflow of $2.7 billion, our second highest year, and solid profitability and lower working capital in the second half of the year contributed to the strong cash generation. Capital expenditures in 2020 were $528 million, down $172 million from 2019, as we reprioritized and reduced our plans in response to the pandemic-induced global economic contraction. We returned $1.4 billion of cash to shareholders, or 52% of operating cash flow, in the form of share repurchases and dividends in 2021. We repurchased 3.9 million shares throughout the year at an average price of $164. After pausing share repurchases at the end of the first quarter in the face of unprecedented uncertainty, we resumed repurchases in the fourth quarter. In doing so, we completed the 9th share repurchase program approved by our board of directors and began repurchasing under our 10th program. In October, we raised our quarterly cash dividend by 3% as visibility to improving demand increased. Moving on to the operating segments, I will summarize their 2020 results and provide our current forecast for 2021. For the engine segment, 2020 revenues decreased 20% from a year ago, while EBITDA increased from 14.6% to 15.4% of sales. In 2021, we expect revenues to grow between 10 and 14%, with this increase primarily driven by higher truck production in North America and stronger aftermarket revenues also in North America. 2021 EBITDA is projected to be in the range of 14 to 15%, compared to 15.4% of sales in 2020. The benefits of higher volumes are expected to be more than offset by lower joint venture income, which I'll comment more a little later, and an increase in product coverage costs associated with new product launches. In the distribution segment, revenues decreased 12% from a year ago to $7.1 billion. EBITDA increased as a percent of sales to 9.3% compared to 8.6% a year ago. We expect 2021 distribution revenues to grow between 6 and 10% compared to 2020, with this increase primarily driven by stronger aftermarket activity in North America. EBITDA margins are expected to be between 9.6 and 10.6%, up from 9.3% in 2020, as we continue to realize the benefits of our North American transformation work and other improvement actions in international markets. Component segment revenues declined 13% in 2020, while EBITDA decreased from 16.2% of sales to 16%. This year, we expect revenues to increase 9 to 13%, primarily due to higher industry truck production in North America and incremental revenues from new products in China and India following the implementation of National Standard 6 and Bharat Stage 6 emissions regulations. EBITDA is projected to be in the range of 14.4 to 15.4% of sales compared to 16% in 2020, primarily due to lower joint venture income in China and launch costs associated with some of our new NS6 products in China. In the Power Systems segment, revenues decreased 19% in 2020, and EBITDA declined from 11.7 to 9.4% of sales. In 2021, we expect revenues to increase between 7 and 11%, primarily due to higher demand for mining engines and power generation equipment. EBITDA is projected to be between 10.1 and 11.1% of sales, up from 9.4% in 2020, primarily due to the benefits of higher volumes. In the new Power segment, revenues increased $72 million in 2020, and our operating loss was $172 million. In 2021, we anticipate revenues between $110 and $130 million. Net expense is projected to be between $190 and $210 million as we continue to make targeted investments in our technology portfolio, consistent with the projections we made at our Hydrogen Day. As Tom mentioned, we are projecting 2021 company revenues to be up between 8 and 12%. Company EBIT margins expected to be in the range of 15 to 15.5% of sales compared to 15.7%. The benefits of higher volumes are expected to be partially offset by weaker joint venture income and the impact of restoring compensation following temporary salary reductions in 2020. Weaker demand in China following a record year in 2020 and lower earnings in India following tax and other one-time benefits last year are the main drivers of the lower joint venture income. As Tom mentioned, our guidance for joint venture income assumes that truck demand in China will decline sharply in the second half of 2021, following the countrywide adoption of National Standard 6 emissions regulations. At this time, we have limited visibility to industry demand beyond the first quarter, and will continue to provide updates in this important market as the year progresses. We are projecting our effective tax rate to be approximately 22.5% in 2021, excluding discrete items. We expect our 2021 capital investments will be in the range of $725 to $775 million. As we've discussed in prior years, our base case is to return 50% of operating cash flow to shareholders, and in years when we expect our cash flow to exceed the needs of our core business, we'll return more. In 2021, we currently plan to return 75% of operating cash to shareholders in the form of dividends and share repurchases. To summarize, we delivered strong results in 2020 in the face of unprecedented challenges, extending our track record of raising performance cycle over cycle. This solid financial performance was only made possible by our employees who worked tirelessly to support our customers, manage through customer shutdowns, and amid significant fluctuations in demand. They managed all of this while adjusting the way they work and maintaining financial discipline throughout. As we enter 2021, we are well positioned to capitalize on strengthening markets to deliver another strong year. We will continue to invest in the products and technologies that will fuel profitable growth in the future and return capital to shareholders while maintaining the flexibility to ensure that we can weather any volatility that may lie ahead. Thank you for your interest today. Now let me turn it back to Jack.
Thanks, Mark. Out of consideration to others on the call, I would ask that you limit yourselves to one question and a related follow-up. And if you have additional questions, please rejoin the queue. Donna, we are now ready for our first question.
Thank you. Once again, ladies and gentlemen, that is star one if you would like to register a question at this time. Our first question is coming from Jamie Cook of Credit Suisse. Please go ahead.
Hi, good morning.
Morning,
I guess
Jamie.
Good morning. I guess a couple questions. First, the commentary on China. Just wondering, I think you said just wondering if you could clarify how much visibility you have into that market or what the OEs are telling you about production, relative to your forecast of down 25 to 30, and given I think January was up about 60%. So I'm just trying to figure out how conservative that forecast could be or what you expect first half versus second half. And then my second question, the market is talking a lot about supply chain issues. You talked about that in the fourth quarter and risk into 2021. So if you could sort of elaborate there and what are, the supply chain risks and costs embedded in your guidance. Thank you.
Yep, James and Mark, so I'll cover China here. So we do not have concrete forecasts for the full year, of course. In any situation, demand varies due to a number of considerations, but we are hearing a very cautious tone from our OEM customers in China about demand in the second half of the year. It is true that demand held up strongly through the second half of 2020. And yes, you're right, the industry's off to a strong start in Q1. We don't expect to see that significant decline in Q1, that's for sure. So hence we've made clear our assumption, and we will keep you updated, but we don't have concrete visibility.
Jamie, just one thing to add on China. I think you hit on the key point. The first half to second half is going to be really different, and so it's really going to be hard to tell whether our assumption is conservative or not in the first half. We'll just see. It just seems like the number of trucks and excavators being produced just seems like a lot for us relative to the economy's ability to absorb it. Again, that's just from history and experience, and we'll see. Last year was just an enormous production build. And as Mark said, OEMs are cautious about the same thing, but nobody has a firm grasp on it. And then there's the emissions change in the middle, which also seems like it could impact things. So we're using our experience and history here to make this call. We did the same thing in 2020 and got it wrong. It ended up being strong all year. So we'll see, but the first half is likely to be good, and then we'll know a lot more as we get through the end of the second quarter about how the second half is going to go. Let me let Tony talk a little bit about the supply chain. There's a lot to say about that, and Tony's got a lot of details about what we're doing to try to work through with our customers and our suppliers on supply chain issues.
Morning, Jamie. Just very quickly, I just want to say that the most interesting thing that's happening is the rate at which demand has increased. We've never seen an increase in demand happen this quickly. And that combined with COVID and the pandemic has really stretched the supply chain. Mark mentioned we did have elevated freight costs in the fourth quarter of last year, and as he said, we expect those to continue through the first half. We are working with all of our suppliers. The supply base is generally tight, not just semiconductors, which has gotten a lot of press, but many of our components are on longer lead times. Our suppliers and we are struggling with absenteeism due to COVID, and we are working very closely with our customers to remain connected and to continue to supply them as best we can. We are working through all of these issues on a daily basis, and the costs that we expect are included in our guidance, and we expect to be able to supply what we believe our market forecast is that Mark said earlier.
are you going to give what the costs are? And then I guess are the supply chain issues, to what degree are they limiting your top line forecast, if any? I'm just wondering if your top line forecast is more conservative because you're just worried about, supply chain issues and that's sort of a headwind to your guide, outside of just costs.
Just to clarify, Jim, so the costs are about 60 basis points of a hit in Q4. We'd expect that level to continue in Q1 and Q2. And after that, our guidance assumes that starts to get better. Yeah.
And is there anything limiting your top line guide, Mark, in terms of like you just assuming sales are lower because the industry has bottlenecks?
I mean, it's clear in the short run it's tight. We anticipate that supply chains ease in the second half of the year. That's the best way to say it. But no, we've given our range of market sizes, and we expect to be able to meet all of those.
But Jamie, if you step back from it, there's no question that supply chain constraints are impacting everybody's view of what the production's going to be. So OEMs, suppliers like us, first tier and then second tier, everybody knows that there's supply chain limits. It's hard for us to see because our customers are driving our demand, how much they're weighing in their own limitations versus what they see customers ordering and things. But it just as every conversation, supply chain comes up. So I just assume it's having some impact, but we are expecting to be able to fulfill our customers' needs, as Tony said, throughout the year. It's just hand to mouth every day.
And just to build on what
Sorry, go ahead, Mark.
It is the most rapid rate of increase that we've seen. So the question is, how long will that? What pace will that sustain? We're optimistic about growing demand. Yeah, but there's some noise in the system given the supply chain tightness.
Okay, Mark, I'll let someone else give you a hard time about your margin guidance. Just kidding.
Thank you. Our next question is coming from Ann Duignan of J.P. Morgan. Please go ahead.
Hi, good morning. I'll skip the margin questions and turn to more strategic questions. Yesterday, you were part of an industry announcement on hydrogen, the alliance that was put forward, particularly for the U.S. And I'm wondering if you could talk about that and, where you see the U.S. going in terms of a hydrogen future versus Europe. It's easier to see it happening in Europe given their lack of energy independence, but, maybe not the same sense of urgency in the U.S. So just curious to hear your thoughts on that and where you think we go from here with this alliance.
Thanks for that, and I really appreciate the question. Yeah, the Hydrogen Forward Alliance is really just trying to make sure that those of us that are investing in the industry are making it clear to policymakers and other potential participants what the opportunity is with hydrogen. Because I do think if you just check in with people's imagination about what a low carbon future can look like, I think everybody from government regulators to my kids understand what battery cars might mean and all that, and they get it. I think the role that hydrogen is going to play in larger energy use, more energy dense demand is just not as clear. And I think we need to be more proactive in helping people understand what it can mean to our entire energy system, and of course what it can mean to equipment that we might supply. So we decided that since a lot of us have been investing a lot of time and energy in that and see the opportunity, we better start telling people about it. So that of course includes Biden administration and regulators, but it also includes general public and I think a bunch of industry participants or people who could be participants understanding what investments might make sense. That's the goal of that initiative, and I agree with exactly what you said, that Europe has moved much faster to understand the role that hydrogen can play both in energy storage, cleaning up high carbon industries, steel making and others, as well as potentially in transportation like trucks and trains. And I think the U.S. really does lag there, and part of it is what I said, is just the understanding of regulators and others is not as good. But part of it is also because we kind of went into a different phase, I guess, over the last 4 or 5 years where we weren't really doing much for energy planning. I see that changing. We've already had several conversations with members of the Biden administration or transition people about trying to put together a more comprehensive energy strategy for a low carbon future. So I'm optimistic that not only will we have a more comprehensive plan, but that hydrogen will play a role in it. And we're trying, of course, to impact that. I think we do believe that for the kind of commercial industrial applications that we're involved with anyway, that hydrogen-based technologies can have a big role, which is why we're investing in it.
Clearly, and I appreciate that, and I agree with everything. But then during your Hydrogen Day, just a quick follow-up. I mean, you guided to revenues for electrolyzers, but you didn't guide any revenue for fuel cells, and in particular the rail side. Is that because, in your time frame, those will still not be really material, and we'll have to wait beyond that? Or was there any other reason why you didn't guide to any revenue for fuel cells?
And this is Jack. I think there's nothing more behind it, but besides the fact that we just have a bit lower visibility, and the lead time behind those orders is a bit lower than on the electrolyzer side. So, as Tom mentioned in his comments, there's solid momentum in the rail space with Alstom and others, and as well as on the fuel cell markets with some prototypes with fleets hopefully this year.
And we'll try to give more visibility to what those look like in the future. Again, as you heard from Jack, the rail side, we know what the orders are. We just don't know the rate and pace by which they're going to be able to take them. It's still a pretty low-scale operation, both on Alstom's side and ours. So we're working through all that. But we'll give more visibility as we understand. I get why it might be interesting to those that are watching the industry. So we'll see what we can do to provide more guidance there.
Okay, I appreciate that, and I'll get back in queue. Thank you.
Thank you. Our next question is coming from Noah Kaye of Oppenheimer. Please go ahead.
Good morning. Thanks for taking the question. I guess, can we maybe talk a little bit about the priorities for R&D investment this year? You'd mentioned, some of the launch costs associated with NSX and BS6, but as we kind of get through that, we've got advanced clean trucks on the horizon, some other emission standards, plus the ongoing investment on the new power side. So can you just kind of highlight for us where the investment is going, and I guess at the end of that, are you kind of looking for R&D to get back to the 2019 level? Are we looking for a step up in R&D here?
Yeah, it's a good question, Noah. We will continue to invest significantly in R&D, both in our core businesses and our new power businesses. As we talked about, maybe it was beginning of last year, we expected R&D to, over time, to increase some over, what we were experiencing when we really just had one technology to invest in. So as a percent of sales, we expect to continue to drive up R&D to some degree, because we're investing both for a low carbon future and the existing products at the same time. And so there are significant investments for both low emissions diesel products across the world. Those are in components and in engines. We've now got new regulations in California to meet. Plus, we've got all those new power technologies. So we have a lot to invest in. So you should expect R&D costs to come back to normal after 2020, and in fact to continue to grow as a percent of sales. Although again, some are shown in the new power business, some in the engine business, so they're mixed around. But as a total matter, we are investing more in R&D.
Okay, that's very helpful. And then just wanted to ask about the pipeline for new platform wins. Congratulations, obviously, on Isuzu, starting to ramp this year. But do you look at 2021 as kind of a sort of a ratable year of potential new platform wins, or are we maybe getting to an inflection point this year where there are just more decisions being made, and so you have more shots on goal?
It's a great question, and of course, that as we've said, we are having conversations with lots of different customers, partners about this, and have been for some time. And I've been thinking that the year that they need to make decisions was the year I'm in for the last several years. It's a complicated conversation for all involved, both because there's a lot of strategic choices for the customer about where they want to invest and where they don't. there's employees and facilities and other decisions to make. So it's a complicated set of decisions. We are talking to a number of customers and do expect some of them to choose to invest in other technologies other than diesel in the coming years. And we think we're positioned well. We'll see, but we think we're positioned well to win some of that business. But we are continuing those conversations, and again, I expect some more to come this year, but then I expected more last year too. So we'll just see where it goes. And but we are having conversations with lots of people. And as you said with Isuzu, it's a meaningful step in that partnership. That's a good example. We've actually had a collaboration with them for several years now. It's been very meaningful conversations, but it's complicated for them to figure out how to navigate this, and this is an important and meaningful step for them. And I think the beginning of a lot of things we can do together, and I believe that other customers are in the same spot.
Okay, thanks, Tom. Good luck and good health to the team in the year ahead.
Thank you, Noel.
Thank you. Our next question is coming from Jerry Revich of Goldman Sachs. Please go ahead.
Yes, hi. Good morning, everyone. I'm wondering, Mark. Hi, Mark. I'm wondering if you could talk about, if we do see upside in revenue relative to your outlook. Can you just talk about what level of incremental margins you would expect to achieve in that scenario if sales are 5 or 10% above the range that you outlined? How would you expect, given the supply chain issues, operating leverage to look relative to the starting point of the initial guide?
Yeah, Jerry, I think typically we've demonstrated over a long period of time that if it's products that we're already making and in serial production, then we can get incremental, and the supply chain's functioning well, then we can get incremental gross margins in that kind of low 30% range incrementally. I think we've done that consistently over time. The issue becomes when we get these extreme changes, and then we need to adjust and supply chain needs to adjust. But yes, if we get more revenue, we can deliver that efficiently. That's the range. That's the range of incremental gross margins on current products.
Okay, terrific. And then, Tom, in terms of the electrification products that you mentioned, obviously you have a strong position on school buses and transit buses. Can you just talk about, based on the production plans for the industry that you have visibility on, where do you expect your market share to shake out on buses versus trucks? Is that something that you could talk about at this point, or if it's too soon, maybe you could just talk about platform share? Any way for us to think about it would be helpful.
Yeah, it's a great question, and of course we're all interested in this question because I think our strategy as a supplier to the industry is to maintain leadership irrespective of technology, and we're investing in the key technologies that we think take us from diesel today through hybrids, through other fuels, all the way up to low and zero tailpipe carbon technologies. And our intent is to invest in the technologies and with the customers that we think are going to win. So we're leading today and we end up leading then in those new technologies. There's a lot to play for in that, but that's our strategy. That's what we're aiming for. And the challenge now on the BEV or battery electric vehicle or even fuel cell technologies is that they're not in the money in trucks. So when you try to put a truck into production or into operation, you're going to be out of the money at the start. And so they're mostly regulatory driven or some other subsidy driven, which means that it's not really a straight technology and performance kind of discussion. And so right now, market share is bouncing all over the place, and because there's a lot of different players that can offer a system. That system is unlikely to be competitive long run, and even the systems we offer are do not return if you compare them to a diesel system today. So market share is really, really difficult to say right now because the basis of competition is not technology and performance and cost. It's a whole bunch of other things. But that said, we are intending to win as many partners and as many products as we can, so we can get A, practice and learning on the technology, and B, help customers understand how they might be able to turn these these technologies into winners over time. So we are competing, don't get me wrong, but it's just the basis of competition is not the normal performance cost trade-off we're used to with diesel.
Thank you. Appreciate the discussion.
Thank you. Our next question is coming from David Raso of Evercore. Please go ahead.
Hi, thank you. Yeah, my question is on the margins. First, the incremental margins. All in, they're implied only 11%. Obviously, the lower JV income is the big drag. But even if you exclude the JV income from both years, the implied incrementals are only 17%. So that's about 150 to 250 million of higher cost than you would normally expect, right? Meaning, instead of 17% incrementals, you would think 25 to 30. But when you said 60 bips, I think, Mark, you mentioned it was 60 bips of a drag you expected for the next 2 quarters. 150 to 250, call it, 200 midpoint. That's like a full 100 basis points of drag. So can you help us understand how do we, bridge that? Can you talk about some costs that you already know can be quantified? And then I have a quick question on the JV income related to margins. China, how big of the decline do you expect from the total company JV income going down about 125 million year over year? How much do you expect that to be from China? Because China was about 215 last year. I'm just curious how much of the total 125 do you think is from the JV and the JVs in China declining?
Okay, good questions, and your math's all right, David, so that makes it a lot easier for me to answer your questions. So of the JV income, you need to remember that we had about $54 million of income in India, which was more one-time in nature. $37 million from the change in the tax legislation, which reduced our prior accrued withholding taxes on our JV earnings in India. And we also had a fairly large tech fee in the first quarter of 2020. So there's $50 million, and then the balance is really market decline in China. On to your other question.
Can I respond to that real quick, though? The China decline, if you went from 215 all the way down to, say, 140, right, that's accounting for the rest of the total company decline. JV income in China hasn't been that low in 4 or 5 years. And I'm just trying to understand, if you know the decline's coming in the back half, at least the way you're managing your business, why would the JV income in China fall that hard? I mean, the JV income hasn't been really even at that level and much below it for a decade. So I'm just trying to square up why such a decline in the JV income in China, especially if you're predicting it's coming.
Well, we've assumed it's coming. Right now, that's a second half assumption, but it's principally a volume assumption. Again, there's some incremental costs associated with launching products, but the primary reason is the volume decline. There's always some other bits and pieces in all the other 54 joint ventures, but these are the basic 2 themes, David. There's nothing else I'm trying to not share with you about the numbers. When we get back to the bigger margin, you're exactly right. Yes, the piece that's missing, which I've been trying to telegraph to everybody, is the $165 million in salary reductions last year. Normally, we expect to deliver 20% plus incremental margins. You're absolutely right. What was abnormal about the actions we took in 2020 was that salary reduction, which was $165 million. That's really that, and our incentive comp will be, if we hit our target slightly higher this year. When you add those, those 2 items alone take about 100 basis points off the margin, and that's the piece I think that's missing. There's other puts and takes.
The price cost, to be fair, provides a little bit of risk then. If it's the comp coming back that reduces it from 25-30% down to 17 for the core business, price cost, I assume then you must not have too much of a negative price cost in the guide.
No, we're kind of 0 to 50 positive on those.
Okay, that's helpful. I appreciate it. Thank you.
All right, thanks, and David, and thanks everybody else. Jack, I think we are at the top of the hour.
That concludes our teleconference today. As always, thanks to everybody for your continued interest in Cummins. I will be available for questions after the call.
Ladies and gentlemen, thank you for your participation. You may disconnect your lines at this time and have a wonderful day.